In this video, we'll be covering Chapter 7, Activity-Based Costing. So we'll focus on the differences between ABC and our traditional costing systems, and then work through a couple examples of how to allocate cost to our cost pools, and then get those cost pools assigned to products and customers. So our first objective in Chapter 7 was to understand activity-based costing and how it differs from a traditional costing system. So in activity-based costing, non-manufacturing costs might be assigned to products, not just manufacturing costs. This would happen on what we call that cause and effect basis. So we'll really be looking to determine what our cost drivers are for particular activities and how that relates to the incurrence of costs in our production process. So our manufacturing costs, if we think back to our traditional product costing, that's direct materials, direct labor, manufacturing overhead. Those were the only things that were being assigned to products under that traditional costing. Again, in activity-based costing, we may be assigning some non-manufacturing costs to products, and we also might be skipping some manufacturing costs. So if we think about that in a short little flow here of those two different types of costs, all of our manufacturing costs got assigned to products under our traditional costing. Most, but not all of those end up being assigned to products under ABC. And then non-manufacturing costs, in addition, some of those will be assigned to products under ABC, whereas none of those were assigned to products under our traditional costing. So ABC does exclude our organization sustaining costs and these idle capacity costs from product costs. We'll talk a little bit more about what those are in a moment. ABC differs from traditional cost accounting because a whole bunch of overhead cost pools are now going to be used. So again, if we think back to our job order and process costing, we tended to have either a single plant-wide overhead rate via which we assigned overhead costs to products, or in process costing we had those departmental overhead rates. So maybe we had 2, 3, 4 overhead rates, one for each department that products traveled through, via which we assigned cost to products. Now under activity-based costing, we're going to have nearly infinite number of cost pools, which increases the complexity of the costing system, but hopefully it gives us a more accurate picture of the costs that are being incurred by each product or customer. So each ABC cost pool has its own measure of activity, while our traditional cost systems tended to rely on either the direct labor hour measures or the machine hours to allocate all of those overhead costs to products. So we still may use labor hours or machine hours for individual activities in our ABC system, but we're also going to use different measures at different levels. So we may have the number of orders for something that's sort of order driven or batch based. We may have number of machine setups if it's a batch level activity, something that occurs for a certain subset of units of product. And again, we'll talk about those levels of granularity in a couple minutes here. But suffice to say, under ABC, we typically have far more cost pools than we would under our traditional costing systems. So relying exclusively on labor hours and machine hours, as we did in our traditional costing system, is generally seen as less accurate from a costing perspective, particularly because labor and overhead costs have been moving in opposite directions with regard to production in recent years. So everything has become much more automated, right? If you think back even to the last 25, 30 years. So labor costs have certainly been decreasing, while overhead costs have been increasing substantially. In addition, companies tend to produce a much wider variety of products these days than they did in the past. So to get a more accurate picture of the costs that are driven by individual products and services, it's necessary to take that cost analysis down to a more granular level and analyze the individual activities that are driving those costs. So a few definitions for us as we begin to look at our ABC costing systems. An activity is anything that causes the consumption of overhead resources. So again, it might be a customer order, it might be some direct labor measure, it might be a machine hour measure, it might be the setup of a machine, It might be a design change for a product. Again, almost an infinite number of things that we could consider an activity, but suffice to say for now that it's anything that causes the consumption of some kind of overhead resource. An activity cost pool is our cost bucket in which those costs related to it, an individual activity measure, are going to be accumulated. So we'll dump all the costs associated with a particular activity into its associated activity cost pool, and from there we'll worry about assigning it to individual products or customers. An activity measure is really just another name for our allocation base. So if we think back to our job order and process costing systems, we had those total machine hours, total labor hours, and so on. An activity measure is a similar idea. Number of customer orders, could still be number of machine hours, number of design changes, and so on. So two common types of activity measures we'll be using are transaction drivers and duration drivers. Transaction drivers are simply a count of the number of times an activity occurs. So if it's customer orders we're talking about, then the transaction driver is number of orders. Duration drivers, on the other hand, are a measure of some amount of time needed for an activity. So if we think about some of the duration drivers we've already used, like machine hours and labor hours, again, something that measures the amount of time that's kind of burned up by a particular activity. Our traditional costing systems relied almost exclusively on allocation bases that were driven by volume of production, and our activity-based costing systems define 5 different levels of activity that often don't relate to the volume of units produced. So those are unit level, batch level, product level, customer level, and organization sustaining level activities. Those are typically the 5 categories we're going to use to classify individual activities. So a unit level activity is an activity that is run or incurred or done for each individual unit that we produce. So if we're making furniture and we're making tables, a unit level activity would be painting. Right? We have to paint every single table. So the costs incurred to paint tables, we can trace or allocate on the basis of each individual unit that's being painted. A batch level activity is performed once for a certain group of units. So it may be machine setups in our factory. We may have to set up a lathe machine to run a bunch of different tables down the assembly line, and we're only going to do that once for some particular, again, batch or volume of units. A product level activity is done only once for a particular product. So that may be a product design change. Right? We only do that one time, and then we run an indiscriminate number of batches and units based on that new design. Doesn't mean we can't do the design change again. It just means for each design change we have, that's not dependent on the number of units or even batches that we produce of that product. Similarly, a customer level activity is incurred at the customer level. So if we are making follow-up calls to test customer satisfaction, we're going to say that the cost of that satisfaction survey that we're calling to perform is executed once per customer. So it doesn't matter how many products that customer has purchased, how many units they purchased, and so on. Just the fact that they're a customer means we're going to incur that cost one time to contact them. And then our organization sustaining activities are our top of the house activities. So things related to the corporate office, or if we think of our factory setting from our earlier chapters, things that are happening in and around the factory that aren't related to even the number of different products we're producing. So real quick sidebar, we have some characteristics associated with a successful ABC implementation. These are very general points of discussion, but just wanted to hit on them quick. So to have a successful ABC implementation, we need strong top management support. So there really has to be a tone set at the top of the company that, hey, this is an initiative that we're committed to. We're going to make it work because it's valuable, and everyone needs to do their part to make that happen. We also generally need to link how people are evaluated and rewarded to that activity-based costing system. So if employees are continuing to be evaluated and rewarded using our old traditional costing data, they're going to kind of perceive that ABC isn't that important, and they're not going to take the necessary steps to make it work. And then really we should be creating some cross-functional teams. So cross-functional employees that are touching different parts of the production or service process, do have intimate and specialized knowledge of operations, and that knowledge is going to be useful in determining what our cost pools are, what activities are really driving the costs in our production process, and how those things interrelate. Right? Nobody knows their job better than our own employees, and so they're going to be the source of kind of the best estimates related to those costing concepts. So let's look at a little example here for Baxter Battery. So we have an income statement for the year ended 2017. We know sales, cost of goods sold, and all of their selling and admin expenses. Again, this is our traditional format income statement. The company makes two types of batteries, the Short Start and a Long Life Deluxe battery. And recently Baxter here reported their first loss ever. So to come up with the necessary components of an activity-based costing system, we first want to select activity cost pools and activity measures. So we want to say what things are driving each individual cost within our costing system. How can we pool these things together in a meaningful fashion, the way they interrelate in the production process, and what's a good measure of what's driving those costs. So Baxter comes up with these cost pools here. Customer orders, which are driven by the number of customer orders as a measure. Design changes, which are measured by the number of design changes. Again, these are transaction drivers. Order size, which is measured by machine hours, so a duration driver. Customer relations, measured by the number of active customers. And then everything else that doesn't fit. And we don't have an activity measure there because we're not going to be able to allocate or assign costs from this cost pool to individual products and customers. We're saying these things are really things that are just incurred in the natural production process or cost of doing business, and we can't determine how those should be allocated to individual products or customers. So a quick look again at our cost pools. Customer orders, we're going to assign all the costs of resources that are consumed by that process of taking and putting together customer orders. Design changes, we're going to dump into that cost pool all the costs consumed by customer requested design changes. The order size cost pool is going to be assigned all costs of resources that are consumed as a function of the number of units produced. So that is driven by volume. Our customer relations cost pool, we're going to assign all costs associated with simply maintaining relations with customers to that pool. And then again, our other cost pool is going to be all those organization sustaining costs and our unused capacity costs. So learning objective 2 in chapter 7 was to assign costs to cost pools using a first stage allocation. So let's say we have these overhead costs for Baxter. So in the production department here, we have indirect factory wages of $6 million, factory depreciation of $3.5 million, utilities of $2.5 million, and so on. We're going to assign direct materials, direct labor, and shipping costs directly to products and customers, so we won't need to be dumping those into our cost pools. So that part isn't really different from our traditional costing system. So at Baxter, we have this following distribution of resource consumption across activity cost pools. So there is a lot of detail here, and most of it isn't sort of critical for our initial example, but suffice to say that we would need to come up with some kind of allocation matrix like this to determine what percentage of each individual cost, so indirect factory wages, the factory depreciation, and so on, to allocate to our activity cost pools. And again, those pools are reading across the top here. Orders, design changes, the order size, the customer relations, and other. So when we came up with that allocation matrix, we're going to use those percentages to allocate to those cost pools all of those costs that we previously saw on that cost schedule. So again, those were here in this blue box. Everything from indirect factory wages all the way down to selling expenses. So taking those one at a time, just for some explicit examples. Indirect factory wages were a total of $6 million, and in our allocation matrix we'd said that 30% of that is consumed by customer orders. So that means we're going to assign $1.8 million, which is 30% of the $6 million, to that particular customer order cost pool. And we can show that real quick here. Again, our cost pools are the columns in this particular matrix. Similar idea for our other costs. So depreciation was next up at $3.5 million. We had determined that 20% of that is consumed by customer orders. So we're going to take 20% of that depreciation cost and stick it in the customer order cost pool. And we're going to do that for every individual cost from our cost schedule. So to fill some of these in, again, our customer order cost pool had the $1.8 million in indirect factory wages, $700,000 in factory equipment depreciation, so on and so on, all the way down and all the way across. So when we fill all those in, there's a lot of tedium, so we'll skip that for now. Customer orders cost pool ended up with a little over $4.5 million in costs. The design changes cost pool ended up with a little over $3 million, and so on down the line for our other cost pools. So again, to recap real quick, our 2 steps so far are: 1, to determine what our cost pools are first and the activity measure we're going to use to allocate costs from them. Then we need to allocate our costs to those cost pools based on that allocation matrix we put together that I'll back up to real quick here. Again, we won't be doing much of this in ACC 121 here. It's a little more advanced. These would just be based on estimates, again, from our employees, from management, from people that know the production process, just estimates of what they think each cost pool kind of uses up of these individual costs. So learning objective 3 was to compute activity rates for those cost pools. So let's assume that the ABC team here at Baxter determines that total activities for each cost pool are as follows: 10,000 customer orders, 4,000 design changes, 800,000 machine hours, and 2,000 customers served. So now we can come up with individual activity rates for each cost pool by dividing the total cost that we've dumped into the cost pool by the total activity levels. So the nice thing about that is that functions really the same way as our predetermined overhead rates under our traditional costing system. It's still total estimated cost, now for an individual cost pool, divided by total estimated activity. So for customer orders, that's $4,520,000 in total estimated cost, divided by 10,000 total estimated customer orders, means an activity rate of $452 per order. Same idea for our other cost pools. Design changes, total estimated cost that we'd assign to that particular cost pool, divided by total estimated activity, and there's our activity rate for design changes. Again, same for order size and customer relations to finish this out here. So we want to end up with an activity rate for each of the cost pools from which we want to assign costs to products or customers. And then just a quick note here, we don't have an activity rate for our other cost pool because, again, those organization sustaining costs, we said, well, we can't assign those to products or customers, so we don't need an activity base for allocation, and we're not going to have an activity rate as a result. Just a quick reminder that direct materials are being traced to our cost objects, as is direct labor, and as is shipping costs, which, if you recall from our earlier chapters, we used to treat as sort of a period cost or a non-manufacturing cost and just expense. Here we're saying, well, we want to trace it to individual products or customers, but we can do that directly. So the overhead costs are what we're really worried about allocating from our cost pools. So assigning overhead to products then, let's assume Baxter again was making these two different batteries, the Sure Start and the Long Life. The Sure Start doesn't need any new design resources. 800,000 batteries have been ordered with 4,000 separate orders, and each Sure Start takes 36 minutes of machine time for a total of 480,000 machine hours. The Long Life, on the other hand, does require new design resources. 400,000 of those have been ordered with 6,000 separate orders. 4,000 custom designs have been prepared, so that's different. And then each Long Life takes 48 minutes of machine time for a total of 320,000 machine hours. So if we look at the overhead cost for the Sure Start, we're going to apply or assign overhead to that product in a very similar way as we had been doing in previous chapters. Now, though, we're using our individual activity rates for our individual activities rather than a plant-wide or department-wide overhead rate. So the Sure Start needed resources, so to speak, from three different cost pools. The customer orders, the design changes, which in fact didn't need any, and then order size. So customer orders, our activity rate for that was $452 per order. And the Sure Start needed or used 4,000 customer orders. So we're going to assign overhead costs 4,000 orders times the rate of $452 per order, or $1,808,000 to the Sure Start product. Again, design changes, we didn't need any for the Sure Start after all, so we're not assigning any cost there. And then order size, we said the rate there was $6.50. So the Sure Start incurred or used 480,000 machine hours. So times that $6.50 per hour rate means total cost assigned of $3,120,000. Again, we're assigning overhead the same way we did in our traditional costing system, only now we're using individual activity rates and our individual activity cost pools rather than plant-wide or department-wide overhead rates. So when we add that up, we get this total here of $4,928,000 in overhead costs assigned to the Sure Start product. And we can do the same thing for the Long Life product. So the activity rates are the same, right? We only want one activity rate per activity. Same across all products and customers. So for customer orders, that rate was $452. The Long Life incurred or had 6,000 customer orders. So 6,000 orders times that rate of $452, $2,172,000. The Long Life did require design changes. So we had 4,000 custom designs that were prepared, times the activity rate of $760 per custom design, for total assigned cost of $3,040,000. And then order size, the Long Life used up 320,000 machine hours at a rate of $6.50 per machine hour, for total assigned cost of $2,080,000. Okay. Then again, we can foot all those numbers to get the total assigned costs here of $7,832,000. And then we'll just highlight real quick that of our total $22 million in costs, recall that we weren't assigning our organization sustaining costs. So if we total the costs assigned to our two products, the Sure Start and the Long Life, we're missing the $9 million and change that weren't assigned because they were those organization sustaining costs. So we should be able to reconcile back to our total costs incurred. So let's look real quick about how Baxter's system works for just one of their customers, Acme Auto Parts here. So Acme placed a total of 12 orders, and we'll note that 4 orders for long lives required a design change. So in terms of orders, we had 8 orders for 60 sure starts per order, and then 4 orders for the 50 long lives per order, and again, those require some design changes. In terms of machine hours, the 480 sure starts required 288 machine hours, and the 200 long lives required 160 machine hours. So to assign overhead costs to Acme Auto Parts as a customer, we follow the same process we did to assign costs to individual products by taking the activity rate for each activity times the amount of the activity that was consumed, in this case by the customer, for each of those activities, and there's our cost assigned to the customer. So customer orders, Acme placed 12 of them. Our activity rate, again, was $452 per order. So that's a total of $5,424 assigned for the customer orders. In terms of design changes, Acme incurred or needed 4 of those at an activity rate of $760 for a total of $3,040. And then we assign the order size and customer relations cost the same way. Order size, 448 of those times the $6.50 per machine hour rate for a total of $2,912. And then that customer relations pool or activity, we had just one of those because they're a single customer, times the rate at $1,540. And there's our cost assigned of $1,540. So when we total that up, we'd say, well, we're assigning overhead costs to Acme Auto Parts at a total of $12,916. Again, if we're interested in the customer as the cost object. Speaking of which, learning objective 5 was to use activity-based costing to compute product customer margins. Okay, so product margin calculations, first step in coming up with one of those is to just put together each product's sales and direct cost data. So for our Sure Start and our Long Life in our Baxter example, we know the total sales generated by each product, and we know those direct costs, so the direct materials, the direct labor, and then those shipping costs. So next we have to incorporate the activity-based costing assignments that we just calculated pertaining to each product. So we'll just bring those forward from our earlier analysis. Again, the Sure Start had the customer order costs, the order size costs, no design changes, while the Long Lives had costs assigned for each of those cost pools. Then to come up with a product margin, we just deduct all of the costs assigned to each individual product from that product's sales. So it's really just sales for the product minus direct costs minus those assigned overhead costs to get to our total product margin. So really we're trying to paint a picture here of how profitable is this individual product in terms of what revenue it generates above and beyond costs that we can trace to that particular product. So in this particular example, the Sure Start generates a product margin of more than $8 million, while the Long Life generates a product margin that's actually in the negative. Right, so the cost that we can trace to the Long Life and assign to the Long Life actually exceed its sales revenue here. So we can reconcile our product margin with the company's net operating income. So again, if we use Baxter here, we had the Sure Start and the Long Life with the product margins of a little over $8 million for the Sure Start, and then that negative $1.1 million for the Long Life. So a total product margin of $7,240,000. Then we'd need to deduct the cost that we didn't assign to products. So we had some leftover customer relations costs, and then that big other bucket for a total of $9,240,000. And if we subtract that total unassigned cost from our combined product margin, that'll get us to our same net operating loss that we saw on the income statement back at the beginning of this example. We can also calculate customer margins. So let's do that for the Acme Auto Part customer we had in our Baxter example. So the first step again is to put together our sales and direct cost information. So we sold Acme a total of $29,200 in goods and services. We could trace direct materials of $7,500, direct labor of $6,700, and then direct shipping costs of $1,700. So to that, we would want to add those ABC cost assignments that we calculated a couple minutes ago. So we had the customer order costs, the product design costs for the special orders, the order size cost, and then that single customer relation cost. So if we deduct those assigned costs and the direct costs from that customer's sales figure, we can come up with a customer margin. So again, for Acme here, that's the $29,200 in sales minus those direct costs, materials, labor, and shipping, minus the assigned overhead costs of customer order, product design, order size, and customer relations. And when we do that, we see that Acme Auto Parts had a customer margin for this particular period of $384. And with the customer margin calculation, similar to the product margin calculation, we're trying to paint a picture of where our profitability resides, right? Which customers in this case are more profitable than others, or are profitable at all. We may have some customers where their direct and assigned costs exceed their sales for a particular period. Doesn't necessarily mean we want to get rid of them, right? Especially if they've been a long time customer and have been profitable in the past. Maybe there's something about the individual period under analysis that's different than other periods. So we don't want to make any snap judgments based on this. But for our particular example here, we'd say that Acme is a slightly or barely profitable customer. Let's just highlight a couple differences between ABC and our traditional product costs. So in our traditional costing system, remember, we do allocate all of our manufacturing overhead costs using some volume-related allocation base. That was always direct labor hours, machine hours, direct labor cost, and so on. Under activity-based costing, we also use those non-volume-related allocation bases. Our traditional costing system generally disregarded selling and admin costs because they were assumed to be our non-manufacturing or period costs. In activity-based costing, we trace to the extent possible our shipping costs to individual products and customers directly, and we also include those non-manufacturing overhead costs caused by products in the activity cost pools that are assigned to products. So another difference here, under our traditional costing, remember we disregard our selling and admin costs because they're assumed to be period costs. Whereas under activity-based costing, we trace to the extent possible shipping costs and things like that directly to products and customers. And we include some of those other non-manufacturing overhead costs that are caused by products in our activity cost pools. And again, we were assigning all of the costs from those cost pools to our products and customers depending on what our cost object of interest was. And then just a couple things to wrap up here. Some of you are familiar maybe with the term process improvement or continuous process improvement. So activity-based management is used in conjunction with ABC to identify areas that would benefit from some process improvements. And the way this would be done would simply be to focus on activities at that more granular level to try to eliminate waste, decrease processing time, reduce defects, reduce rework, all those things that generate sort of unnecessary cost or are wasteful. Our ABC activity rates can also give us some useful information concerning where that waste is coming from and what areas might be ripe for improvement. Right? And then benchmarking is another tool we can use as part of this process improvement effort. We can look at either other departments within our same company that are doing things better, maybe, and figure out, well, why are we short of what they're achieving? Or we may be looking at external organizations to say, well, how are they doing things better than us? In fact, they are. And then just to put a final point on this, let's keep in mind that most companies don't use activity-based costing for external reporting for a few different reasons. For one, external reports are generally less detailed than internal reports, or at a more summary level. It might be difficult to make changes to the company's accounting system. ABC, importantly, does not conform to GAAP. So for public companies that have to publish financial statements, they can't use ABC to do that. And then auditors might be suspect of some of the subjective allocation process that's used to come up with these cost pools and these cost allocations. And then I'd sort of add a fifth one that fits with 1 and 3. We wouldn't generally want competitors to know sort of how we're allocating costs or why we have the cost structure we do. It's not anything that's particularly useful to be made public. So that's another reason why ABC probably isn't going to be used for external reporting. That concludes Chapter 7. Let me know if you have questions as you get working on your practice material. Thank you.